Good morning, traders. Bennett Tyndall with TradingAnalysis.com. We apologize for the little bit of a delay getting started here this morning, but happy Wednesday, April 15th to you guys. Tax day. Wait a minute, taxes got delayed 3 months due to the COVID-19 situation, so you don't have to worry about that. I'm sure most of you guys have already filed, right? That's the responsible thing to do. So, guys, let's go ahead and bring in the Trading Analysis team. Good morning, gentlemen. How you doing?
Hey, guys. Good morning.
What's up,
Good morning,
Todd,
everybody.
Terry, Alex?
Good morning.
Todd, your little audio's a little quiet.
Yeah, I'm trying to figure. I'm at home and I've got my MacBook Pro plugged in, and it's neither picking up this goofy snowball microphone I have nor the camera up there. But I'll be working on it in the background.
Yeah, it doesn't sound too bad. That's the joys of working from home, right? It was funny. I was listening to CNBC yesterday, and they had a guest on, and you could hear one of the hosts in the background. He's talking to his dog. He's like, Max, no Max. It's hysterical. So
I think we could put a timer before Jake and Brody come storming through the door. So just
that's what I was going to say. I've already seen their kids running around in the background and waiting to see the yelling and screaming going on. So.
Oh man, it's unbelievable.
That's just the joys of working from home. So anyways, guys, retail sales came out this morning. Let's go ahead and jump over here. Take a quick peek, if I can get my web browser here into the mix. And as you can see here, down 8.7%. We've got a little bit of an echo. I'm not sure who that's coming from, but so U.S. retail sales down 8.7%. The forecast was 8%. We also have industrial production out this morning, so we'll be keeping our eyes on that. And guys, we're up against a really important zone in the S&P, and this is kind of a zone that can establish the higher degree trend that we've been debating and looking at the various possibilities for. That kind of major zone that we're watching here is essentially the 61.8% Fibonacci retracement of the decline off of that February 2020 high. So we are tracking two different ElliottWave interpretations, both with obviously drastically different outlooks. Both of them technically valid from a rules and guidelines standpoint when considering the ElliottWave principle. So at this point, and I think several of us are in agreement that if we do continue to see a slowdown in the number of COVID-19 cases, we continue to kind of see that flattening of the curve, a reduction in daily hospitalizations and deaths, so forth and so on, in combination with the reopening of the economy, and perhaps that March 23rd low was in fact all she wrote, completing an overall fourth wave flat, which if you take a look at the wave 2 that we're squaring this up against, it would have completed, if this is in fact the count, right just beyond equality of time elapsed in wave 2, which, as you know, corrections of the same degree will often tend towards equality. Additionally, we have this 1272 of wave B, which is very common when you see that kind of extended B wave. We did push to right about a 1618, which is kind of the most extreme that we would anticipate to see out of a flat. And I know Todd has a really interesting chart that I'm hoping he's got handy and we can take a look at here in just a second. So we continue to track both possibilities. I think we'll have a better, more clear understanding as to where this market wants to go as we test this particular zone of resistance here between 2846 and essentially 3100 in the S&P. But if this retracement does continue and we start pushing through that 786, it's quite likely that March 23rd low was in fact all she wrote, but I think a lot of it is going to be dependent upon where things go. So, Todd, what are your thoughts when looking at these two possibilities? And I know you have a chart that you had sent us.
Yeah, leave that chart right there. And let me just ask: is this did this microphone kick in? This guy?
Yep, sounds great.
Oh, perfect. Yeah, you know, it's interesting. On the wealth management side, I've been looking at hedging, and as the market was dropping down there into March, even coming up off the lows in April with an 80 VIX, which is just thinking back. I mean, I knew it was extreme, but unbelievable that we had the same volatility level where we were recording a collapse of the U.S. economy in 2008 and 9. It was just unbelievable. And that's another direction that we could go down. But just talking about the pricing of hedging, I remember pricing out hedges, just looking at the price. If you wanted to do like a 2,000 or even a 1,900 SPX put spread, it was way out of the money. The S&P to around 2,200. You were only going to make like 50% above what you were risking. So you're risking one to make 1.5x. It was unbelievable. Looking for another 20% drop. Like, that's how expensive vol got. Rallying back up, the volatility has been cut in half, and we're down to like a 40. I think we even got below. We got a 3 handle on the VIX. We're obviously back up this morning, but the price of insurance has come way off, amazingly, into Bennett's perfect zone right there. This is, if you guys go old school, old harmonic patterns, that's a Gartley pattern, which is basically a retracement into the 61 to 78.6% retracement, coupled with 2 equal legs, as Bennett's got labeled, parentheses A and parentheses C. Like, this is an old school, just perfect little technical setup. So, as Bennett said already, if we're gonna fail, it should fail from here, coupled with the fact that options have gotten so much cheaper than they were at the lows. So beautiful chart there. Bennett, what chart specifically did you want me to bring up?
The one where you were showing the relationships between the time of retesting the lows post credit crisis.
Oh, cool. Yeah.
I think I might have that. I have that handy. I think right here.
I have it up, and I was gonna pick on one person. Let me scroll through on Twitter, if that's okay. Like, can I just take
of course.
the screen?
Certainly. Let me. You should be presenter. Whoops.
Make presenter. This is a big monitor, so hopefully it's not too skewed or too out of whack. Is that way too big?
No, I think it's. Yeah, I can see it.
Okay, so. And I'll just be real quick, and I want to turn it back over to the guys. But everyone was saying with this drop that we've seen back here, February into March, everyone was saying, we're going to see a retest. We're going to see a retest. And people were just dead set on a retest. And actually, just looking at this yesterday, I was like, all right, well, let's just kind of look back at where we've been. Will we get a retest, and what does it mean? But if you just go back to the beginning of the '09 lows, you'd see something very interesting. I would say that there were 6 prominent bottoms since the '09 low, 2010 into 11, which wound up being 65 weeks, 2014 into a nice little double bottom, in 2018, which was 68 weeks, and then the end of 2018 and 19 low, perhaps that was the double bottom, which was perfect, almost perfect at 65 weeks. So maybe that was the retest. And again, everyone, it's so perfect, and that's something we could talk about with Elliott. Sometimes when things are so perfect, usually the market finds another way to sort of move further. And I couldn't agree with Bennett anymore that it is, a perfect 3-wave pullback. You can count a 5-wave move on the decline. It looks like it wants to sell, but what if there's a greater pattern at work? And yes, you could accuse me of being perma bullish, but when the market's been going up for 100 years, I mean, who am I to try to call the end of that move? Somebody on Twitter gave me some crap, and I was thinking about it. He's like, well, it disproves itself because neither of these made a new low. And I was like, actually, you know what? It couldn't be, guys, I thought this would be interesting. Observing the guideline of alternation. This is perfect. Where this 65-week move made a higher low before moving up. This 68-week double bottom made a perfect double bottom. In fact, it had 3 bottoms, 1, 2, 3. And then this one, obeying the guideline of alternation, we shot through it. So this one we fell short. This was a double bottom. This one fell. This one pushed through. So just food for thought. I am so impressed by the way technology, specifically semiconductors, look at Netflix, look at some of these stocks, look at Tesla, look at how these stocks have come ripping back on the technology, and there's strength in this market. Of course, there's a lot of pockets of weakness. There's a lot of issues out there still, but there are pockets of strength that I think would cause us to not dismiss the idea we may have seen the low at March 23rd. Very good. Yeah, I'm not at all discounting the possibility that, in fact, that was the low. And I know you're I know you're not.
I'm excited to see where this market wants to take us. So, very good. Appreciate you sharing that chart. Anything, any other observations that you want to point out or make as to where the market stands, or where things you might be looking at before moving forward?
No, I'm pretty quiet right now. I'm more relying on your analysis. I'm focusing more on the wealth management side. I'm talking to clients that have come on board every day. Like, I've been on the phone with them a lot, and just focusing on getting their portfolios right, making sure they are allocated where they want to be. Because again, I've done a couple CBC videos putting option hedging strategies out there, and I'm saying I have no idea where this market's going. Like, I've been doing this for 20 years, my whole career. I have no idea if we're going to fail at the level that we're laying out, or we're going to new highs. I just think you gotta allocate capital in places where there's skewed pricing, where there's better risk compared to reward. Volatility's come in, option hedging prices have come in. There is some strength out there. For me, like, I have no idea where this market's going. Like, Alex, Terry, Bennett, like, what's your gut? Do you think we go higher or lower, or are you with me where you have no idea?
Todd, if you don't know where this market is going and you expect me to jump in there and say, I know where it's going, this is totally unprecedented, the economic stress that's been put on the world economy.
I don't think anybody has an edge, and I think everyone's opinion's valid. Like,
It's true. It's such a new environment.
The only comment I want to say, if you throw that long-term chart back up there for a second, I see 2/3. No, the one that, excuse me,
the one that,
yes.
Okay, there you go.
So in this last, so I think nobody else has picked up on this point that the bottom that we set in is the second bottom of the pairs. I think that's a very astute point, Todd, and I was impressed by looking at this. That said, I will also say that in this last two, I see 2/3 of a head and shoulder formation potentially forming.
Yeah.
So right now, where we are exactly today, we are still below the first head. I mean, the first shoulder, sorry. We are still below that level. If the slope of that is down, then I think that gives an inclination that you could end up with a head and shoulders formation. We penetrate this and form a higher shoulder on the right side, then maybe we continue higher. So that's about as best I can do by looking at conventional technical patterns and trying to presuppose what might come. The question I have is, the markets have priced in what they believe the economic impact of all of this is. But even the markets themselves don't have the experience that we're going through, or do they? That's always the question, how efficient the market is in knowing what's about to happen. If this is an unprecedented event, did they really price in all of the economic downturn, or are they going to start being surprised maybe in the third quarter when we get third quarter earnings out and they expected to see a little bit of a recovery and they didn't? So I'm remaining very cautious on jumping all back in right now.
The one thing, Alex, go in 1 second. The great news is, if it's a head and shoulders and we're forming a right shoulder, if it's something, like, we're gonna know in the next week or two. Like, we're gonna know soon. Like, we have to make a decision. I don't think it's just gonna go sideways and decide we're either going higher or we're going lower. I think we're gonna know soon.
Very good. Alex, what are your thoughts on all of this?
Well, you know my stance. I'm not changing it much because the markets didn't change. This is as Todd said before, for me a very complete ABC pattern for a pullback, we have a clearly defined levels from the technical perspective. The risks are relatively low compared to reward. The only thing what I see it's potentially that we gonna maybe even might go in this B wave more complex. So it can maybe try to do a triangle and then move lower. Yeah, exactly. So, I mean, if we just have here two things. We have a real economy, which we know where it is. So we all agree that the numbers everywhere in the world are horrible, and we have people which are basically pricing in the real economy outcomes in the next few months, which are going to be bad. Let's be realistic. And from the other side, we have people which are try to price in actual recovery supported by Fed. Okay, so that's how I see it. I see it two camps. I'm just trying to think what the bear market camp is thinking and what the bull market camp is thinking. So in the bull market, there is a numerous kind of suppositions. Okay, so we suppose that the Fed liquidity injection is sufficient. That's the first thing. We don't know the outcome of the economic, and we don't know how much this thing is going to last. So for me, for the bull case, there is too much unknown. I don't want to buy market on a supposition that Fed is supporting it, but we don't know real outcomes. I mean, if I'm going to buy the market pricing in that everything is over in May, of course not. I mean, that will be not very reasonable. So the only thing left is I'm buying market on a Fed support. And I think this rally is completely caused by the Fed supporting whatever it takes. And it is just the question, are the bears are actually more rooted in reality than people buying the Fed call, as I will put it like this here. So for me, this is the only question, and I'm still leaning toward the more rooted reality that we're going to go down to 1,800, where is also, as I shown and as we shown, very clean technical support from a longer stand wave count, and I'm still going to stay in that camp. Of course, I'm going to be proven wrongly very quickly if we go through this 786. But for me, this buying is not rooted in a reality. But I mean, we have seen this distortion created by Fed between the reality and the markets a few times already. So the prices are distorted. We have to admit that it doesn't represent reality. We can discuss how much of that is already priced in or not. We cannot be specifically precise about that. But for me, I'm still in a camp of a reality. So I'm thinking we're gonna hold this resistance and we're gonna go lower.
Okay.
Very good, sir. Let's switch gears here, if that's all right, guys, and take a look at some sector analysis and see if we can gain any insights as to what's happening in the rotations there. Mr. Terry, whenever you're ready, sir.
There you go.
All right. The screen is yours.
Okay, guys. This is the S&P performance for the 2 days that we've had this week, and we kind of see a mixture going on here. This is the price percent change here. Technology so far has gained about 4.5% in the last couple of days, followed by discretionary, staples, communications, and then healthcare. On the downside, utilities is kind of neutral, but on the downside, your biggest loser is financials. I don't think there's anybody that would doubt that is going to be down there. Real estate last week had a pretty good upsize, over 20% last week, pulling back a little bit this week. Industrials, materials are down there. So far, this is we've retraced it, just a little bit shyer than 50% of this total move down in the market. Here's the weekly rotation. In the weekly rotation, sort these by the highest relative strength ratio. I'm looking furthest out to the right here. I'm seeing technology in the near term pushing down into the weakening quadrant. It's not losing a lot of relative strength, which means it's just more vertical move and momentum. So momentum's kind of waned a bit in technology, while we're seeing strong momentum and relative strength gains in real estate and staples. I'm sorry, not real estate, healthcare and staples. Real estate, I'm seeing actually a bit of a decline. So this is the weekly rotation. The weekly rotation, energy, whatever. I'll steer clear of that for now. Again, let me jump into the short-term daily rotation and show you what's been happening just in the last, let's just pull this back. If we do 10 bars there, let's do 10 bars. That's the last 2 weeks of rotation. I'm going to have to stretch this because it looks like relative strength has been changing a bit. That little circle changes or morphs depending upon the S&P's performance change. But you can see that in the daily rotation, the only thing I can see is energy rapidly gaining in terms of relative strength. Most of the other sectors, 2/3 of them are sitting here to the left of the middle, but you've got healthcare. Last week we didn't have anything in the leading quadrant, and now materials is kind of pushed over there, but again, I don't consider anything substantial until it really gets outside of this circle. Healthcare is this green one here. Healthcare pushed itself down into the weakening quadrant. I expected it to rotate right back up into leading, and it did a head fake move on me here. So this little hook, it suddenly reversed and shifted left again, like it wants to continue a little bit further more decline. So all of this patterns here in combination with the charts that we've been looking at, it's kind of telling me we're reaching a consolidation period potentially in our charts. So that's on the board there. Let's go back to the weekly rotation here again. Resize this. So I mean, we've already talked about this the last time, but let's take another look again. Who are the leaders? It's technology, healthcare, and staples. So let's start with technology. But I've already shown you that I'm seeing near term. I'm seeing a bit of a pause going on in the daily charts. This is the weekly tech sector compared to the S&P. Our clear leader here is NVIDIA. I showed you last week that Oracle was primed to jump out of this improving quadrant and push up higher into the leading quadrant. Take a look at Oracle. Oracle may be one of our new leaders here. Todd, Bennett, you guys put that on your watch list. We're seeing declining momentum in Microsoft and Adobe, but the relative strength is not losing any ground. Apple, on the other hand, Apple is hooking over a bit now and starting to position itself where Apple could start losing in terms of relative strength. This is the weekly chart, so these colors match up to the quadrants that we were in. So you can see back from August all the way up through February, Apple was in our leading quadrant, and then it moved into the weakening quadrant as it's begun this consolidation. Now, if you just look at the ordinary technicals here, a 200-week, a 50-week, and a 20-week moving average, Apple's looks like it's supported itself quite well with this. But when we look at the overall where it's at, still has a 107, 108% relative strength, so we won't count him out yet. But he is wandering around down here in this weakening quadrant. The question will be, will Apple recover and come back up? The dreaded thing that I would hate to see is if Apple pushed below the South Pole here of this axis. Because once it gets over here this far, it's got a long trip to come back around. So it can reverse quickly right here from the weakening and push itself back into leading. But if it gets a little bit further over here, that may be all she wrote for Apple. Let's take a look at Staples here. And this is Staples against the S&P for the last 4 weeks. Continue to see General Mills, Walmart shooting higher, Costco, Colgate, Kimberly-Clark, Hershey's, and Monster pushing higher in terms of relative strength, starting to weaken just a hair here. But so maybe if you start to get your pantries full, you might see a little bit of peel off in some of these. But yes, definitely Staples is becoming premier again.
Yeah, look at General Mills up there.
Yeah, for sure. And switching over in here to healthcare, of course, Gilead and Eli Lilly out front with their research, their advanced research, and potentially working on a vaccine or a treatment for the COVID patients with this remdesivir, I think the IV drug. I'm not exactly sure what Eli Lilly has to offer, but they're certainly were way out in front, I think, even before this virus got itself off the ground. So many of the other healthcare stocks are all positioned nicely to continue their runs up, nice northeasterly vectors, and long too, right? So the longer this is, it means the higher the velocity. If you look in there, there's a velocity factor about 2/3 of the way down that list, and that's really telling you how rapidly has it moved from one point to the other, right? So that's a large velocity. United Healthcare has got a 0.33 velocity. Amgen had a 1.13. So you can see the delta moves here, pushing higher in terms, could give you higher returns, speculating in Amgen versus in United Healthcare simply because of that velocity change there. All right. So anybody got any questions real quick? Anything you want to take a look on the downside? I really don't want to take a look at energy. We can take a look at financials if you want to look at what's going on the downside. So the only stock that I see in financials has been Progressive Insurance. I guess Flo's been still doing a good job with her advertising, keeping Progressive way up here.
Her signature is
tiny. You guys
tiny.
did see where Allstate and several other insurance agencies were giving rebates back for their auto services since people aren't driving as much. I think that's a good thing. I actually, that Allstate announced it was like $2 billion, so that's huge.
It was pretty
right?
significant,
Yeah, my insurance company sent me a letter, said they were giving back 15% of April and May's bill,
Premium.
right? So. Yeah, premium. Thank you for that. So so that could be a good little bonus. It takes away from these insurers, but you got to think that most of these insurance companies, they're taking pretty big hits for something right now, having them down here into this weakening quadrant. So Todd, what does your wealth management guys think about insurers right now? And Berkshire Hathaway is sitting right here, like right at the epicenter of this, which means Berkshire Hathaway and the S&P are in lockstep, right?
They're neck and neck.
Yeah, we don't. I actually was just checking the portfolios to see what we have in insurance. Let me get back to you on that one. But yeah, there's certainly some bright spots in the economy, saving some money, being proactive, and I'm of the view that, just kind of looking at what Alex was talking about with, I was trying to get a reading on current forward earnings on the S&P. I think we hit over 20, just talking to, kind of segueing into Alex, if markets are in fact overvalued compared to forward earnings. We got up to like 20. I'm sure we dropped down to about a 15 or 16 forward PE in the S&P. I'm just thinking more bigger picture. Are we in fact overvalued? It's an interesting question, and it's something I want to dive a little bit more into. But I think what the Fed did in such a short period of time is larger than what they did in '08 over a much longer period of time. It's not. No one's demonized for this. In '08 it was a very hated, in '09 and '10, very hated move to bail out the millionaire bankers who took unnecessary risk and the taxpayers paid them out. Trump getting all over Jerome Powell to keep rates low, to keep the market up, to keep the approval numbers up. That's not what he campaigned on. That was very politically driven. Here, the Fed just pulled out the bazooka on this market. Yep. And there's no one to blame because we all agree that it needs to happen. And I think it's just going to leave a very highly accommodative Fed in place for a long period of time. And the second and third wave of this virus is completely hanging over our heads. So there's no one to blame here. There's no one to blame in this situation, which I think was not the case. And the other times that the Fed was forced politically to become more accommodative and dovish, or we had a systemic crisis stemmed by highly irresponsible banking and speculation. It's just not the case here. It's different. So if we can get past this without a second wave or third wave, the Fed is firmly behind the market, whether inflated asset prices or not. Inflation is just not an issue. Gold is not moving. Crude oil is in the tank. The Fed is a dual mandate, and so long as the rest of the world has full faith and credit of our debt markets, because there's really nowhere else to go. As long as the world doesn't turn their back and can continue to believe we'll pay our obligations, we can keep those rates very, very low and keep a consistent bid in the bond market, which I think creates a positive stock bond correlation, which has been in play for 38 years. So I don't know. I'm so interested. As I said, anybody who's got a valid opinion, I'd love to hear. I don't think anybody has the answer in here. I just can't wait to see how this plays out. It's so interesting.
I was flipping through all the other sectors, and we get here to the materials sector. This one is kind of interesting. Even though all of these stocks down here are in the lagging quadrant, they've all got northerly momentum vectors, very straight, very strong. If you're doing any long-term analysis, long-term bottom fishing, possibly this little group of chemicals companies like Dow, DuPont, LyondellBasell. I think Dow and DuPont separated again, but yeah, there's two different stocks there. What is this? Celanese, Nucor, and Freeport-McMoRan. Might be interesting. Take a look at those on the longer term. Maybe add those consider adding those to your portfolio. They look pretty beaten down, but they've actually are much stronger. Contrast that to looking at energy, right? So I don't see all these guys down here with nice northerly vectors. They're all still potentially pushing south. Really, you only have Williams Brothers and Chevron looking a little bit north here ahead of ExxonMobil. ExxonMobil further out of this 2 standard deviation. Phillips a little bit further out. Your buddy Kinder Morgan, though, is pushed down into the lagging quadrant there. So
he was never my friend. It was just a segment on CNBC.
I was just an insider there, Todd. Semiconductors. Yeah, AMD has kind of made a reversal here, pushed itself down in the weakening, but AMD and NVIDIA are the two clear high, strongest semiconductors right now. So we'll leave it there and pass the baton over to Alex.
Very good. Much appreciated, Terry. We've got, let's see here, just over 5 minutes until the open. S&P futures down 2.64%. Curious to see how this opens here. So, Alex, the floor is yours, sir. Go ahead and take it away.
What would you like me to take away? Okay. So, this is something which I have been observing, and this excess liquidity which comes into the system is definitely now in the bank's accounts, and it is just the question when this starts to be distributed into economy. And also, one thing I'm tracking is this known Milton Friedman formula for velocity of money. And this is one of the theses which also states that most of from 2008 crisis and hence so much of a disconnect between the upper class and the middle and the lower class in a terms of earnings and the wealth distribution. Actually, all of this money which was sitting on the bank's account was available upon the quality collateral, mostly in financial world, not in the real economy up to now. I think now it's going to finish into real economy because whole economy is in danger. So I'm expecting this velocity of money, which actually is the rate of exchange of the one note between the participants in the economy, and which is falling already from 1995. And if you put also the inflation chart here, you can see that through the history, the velocity of money actually also corresponds with some of the really inflation moves on the upside. So I'm just trying to see, and I will follow this chart to see if this money goes into the economy, which starts to produce some type of a quicker velocity exchange when we go out of this situation. And then in that case, the inflation will definitely pop up, which are going to move the 10-year yields higher. So I think also that will be interesting. What will be consequences of that scenario if we start to recover fastly and we see that money actually loaned from the Fed side and given from the fiscal side will produce in economy, and I expect to see some of the things potentially change here. And if you look the 10-year yields on the US bonds, okay, so I think we are definitely close to some form of a midterm bottom there. So I will just show you the chart, and I've been bearish on 10-year yields with our members for already all of this area, but as we can see here, we are still not overlapped this potential move on the upside to completely discount the lower side in 10-year yields. So I think for some time we are still going to grind lower in 10-year yields, but the resolution of this is definitely comes together with this inflation outlook that in one point of time, relatively very soon, the yields will either have a very big correction or then they're going to surpass this high here. Okay, I'm just trying to prepare myself on this front because this will impact also the currencies as well. So I'm just trying to make a few scenarios, and this is all what you can. You can use all your tools and make the scenario and just wait for the signs for each of the plan to unfold and that you are ready to react on it. So I think this is an interesting things what might come after all of this what is going on. My point on the S&P, I don't have anything to add. For me it is just the question who was wrong, the one who priced in the Fed or the real economy. So we will see who is stronger very soon. I'm not personally bearish or bullish, as you know. I mean, I'm looking that from the ElliottWave perspective. I don't have a preference either to this. My personal opinion is to look more the real economy than the discounted value in the future, or what is going to be a price in this situation in a 6 or 8 months. Dollar index is pushing up this morning, and dollar is still unclear. Definitely Fed did much of the plumbing in the offshore dollar markets, much more than in 2008. And I was going some through figures, and definitely Fed even gave the line of dollars to Bank of Indonesia, Central Bank of Indonesia. So Fed is very active in kind of stabilizing the dollar price, because it will ravage the markets around the world if it go higher. And I think they're doing a good job. But still, from the ElliottWave perspective, we are seeing the signs of the weakness, but we cannot be sure that we are going to still continue lower. Okay, so I'm still waiting for the signs. For me, this is still not a confirming price action. I have a 5-wave move lower in the orange wave, one pullback in the ABC. I can count this in 5 waves, but I still want to see dollar move lower to confirm my thesis that in general we're going to see a few years dollar lower on account of a currently large budget deficits in the United States after this crisis, because I think the stimulus is not done. I mean, if these things tries to drag on up to June, July, the Fed and U.S. government will have to add more on stimulus in this circumstances. But I see an interesting thing development in a pound. We have traced out 5 ways up. And the pound is in a small portion a component of dollar index, and this is very interesting development, because if you look the higher time frame, the last from 2004 looks pretty much as an ending diagonal thing, which might find its lows around this price here. So on the smaller time frame, I was waiting actually for the move on the upside, which we got in 5 ways. Clearly, wave 4 and wave 2 do not overlap, and they agree in a matter of time. I doubt you can count this correctively and make a thesis that this will go on a new low. So I will keep looking to be bearish dollar. I'm just waiting a pullback, and then I'm gonna recommend and go long on the pound when I see this this retracement complete. Also on euro dollar, we still didn't see a clarification. I'm still gonna look these two resistance and support levels. This is my bullish wave count, which is still very valid. So I think potentially this is ABC. We held 786. We just bumped through it and came back. Gap is covered. So all of the measures of the corrections are satisfied, and we are trading sideways. So I'm waiting to see are this move on the upside can prove to be a little bit more sustainable or not on euro dollar. And what I see interesting as well is on dollar yen. As we said many times, this is the sideways price action. So I have also 2 scenarios here. I added this one also, that potentially this B wave is still not done. We go A up in down in B up in C, or all of this is just a big nasty triangle, and we're gonna finish higher when the S&P find its lows sooner or later. On the crypto side, Bitcoin still sideways. We had 2 trades with our members, which one was stopped out and one was closed in 2 or 3% gain. So net we are kind of in a break even. I think a little bit in plus, but this is not a trading environment really. We are looking for a potential few scenarios here. You can make this a bullish price action here for now, because this can be a leading diagonal down in 2, and then you have still a 5 waves up, and this might be a second wave. So I'm watching very carefully what's going on in cryptos, but from the larger perspective, price action is sideways. So my conclusion is here, we still need to wait, because we really don't know from the ElliottWave perspective where this one will go, because this can be a triangle, so we can be in an A, B, C, D, and E, and then we go on the upside. This also can prove to be a 1-2, so we are done, we are going up, but for that we need to see 5 waves up and a pullback, and then I'm ready to commit, okay? Or we're gonna go in WX, and this will be some type of a complex, either expanding ending diagonal here for a Y wave. or it's going to be an A, B, C, and some form of a triangle, and then push down to this 2000. So cryptos for me are still no playing ground. I'm neutral, and I'm just observing what's going on there. Still on the, just to go back on currency market, dollar is the big question mark, and the potential inflation is the big question mark, and all of the people which are looking from macro side are looking for the signs. Are the dollar liquidity is completely addressed from the offshore dollar markets, and are we going to see an inflation coming when all of this money is going to directed to the real economy from the massive stimulus around the world? So these are the two questions with everybody's pounding their heads on, because these two questions are crucial for the currency markets and the overall market, I think. In what environment?
So what do you say about gold, Alex? What do you say about gold? Gold.
Yeah, gold, we pushed higher, and we are trading above this 786, which is I mean, we didn't push substantially higher, but we are trading higher. So I'm still looking here, because this area is still, for me, it's not a bullish sign. Okay, if we look dollar higher or dollar lower, I think it will make the gold go up and down, because if we are in an inflationary scenario, gold can probably be the hedge. But I think old rules are not so applicable here. For me, this is not a breakout which I will buy for now. Okay, so for me, I still want to see some commitment from the gold side, that we can penetrate the resistance levels here and these previous highs. So my bullish wave count says that we are in another 1-2. So this is the bullish price action. This is a wave 1, down in 2 in flat, and then we have a beginning blue wave 1, very well defined in the 5-wave pattern. And then we are out of this channel, which is also a relatively stronger bullish sign, and we are tracing a first 5 waves up in the wave 3 of the wave 3. So this one might prove to be explosive, and for me, if I want to be long, I will be looking a little bit more upside, and then a pullback to this 1,650-60 levels, because if we see 3 waves here and a confirmation on the upside, I think we're going to see an explosion of the gold price to above 2,000. So I will be looking here very carefully, because this might be a development. Might be. I'm underlying that. Might be a beginning of the new bull run on the gold, if we get the 3 waves here, which I think it's going to be crucial for the outlook.
Very good, sir. Much appreciated, Alex. I wanted to, before we wrap it up, touch base with our guest. We've got a guest in the house.
Hello.
Hi. We were just listening to Gold. Say hi. She doesn't know what's going on. This is Eden Rose. So Trish is taking care of Jake and Brody on the homeschool, and I thought I'd just take Eden off her hands. It's a little challenging these days. She's a good girl, though. She loves playing with technology. Our thing during this homeschool thing at home is we go down. She loves the movie Moana, so we'll go and sing some songs, and she'll go over and play the drums. And Andrew Baptiste is on the line, a friend of Trading Analysis. He's texting me, says, "Hey, go get the boys." So I couldn't, because we're in homeschool, but here's Eden Rose. And can you say bye-bye? Can you say bye-bye? She's silent. Alex, good. I was listening on the gold. That's good. If this thing finally starts to go, and the pullback from 2000 was so shallow compared to going back to when gold almost hit you, when gold was at like $250. It's been like a shallow 38% retracement. So you'd easily see this thing really start to feed on itself. So don't overlook gold.
Absolutely. She was trying. How old is she now, Todd?
She was born November 1, so we're
Wow.
year and a half or so. She's doing great though.
Awesome. Love it. Gentlemen, appreciate it. Eden, thanks for being here. We'll have you back as a technical analyst, I'm sure, someday in the future.
Rose. She's so cute.
She's kind of blown away.
All right, guys. Hey, if you enjoyed the content, be sure to give us a thumbs up, like, subscribe, and of course, you can check us out at TradingAnalysis.com. Stock options, futures, or I should say Forex and crypto. Just keeping my eyes on the markets here out of the open. So we'll see how the day progresses, and we'll catch you guys next week. Todd, we wish you the best of luck at home this morning.
Oh, we're fine. We're fine. We're all good luck to everyone out there. We're all going through this similar crazy situation. So thanks for listening, guys. Thumbs up on the video, and check this beautiful team out at TradingAnalysis.com. If I can help you on the wealth management side, let me know. We've got all aspects, all components of your trading and investment portfolio complete, right?
Absolutely. All right, guys. Appreciate it. You too. We'll see you next week. Take care, guys.
Yeah, stay safe.